heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's world headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, Elon Musk, he lashes out at the state of financial markets. We'll break down the billionaire's comments and get an outlook for tech stocks in the new year.
And an $80 billion rout underway in China as Beijing imposes new curbs on gaming. We'll break down the implication for the country's giant internet sector.
Plus, we talk all things AI as ChatGPT ends the year with a long list of new competitors. What will 2024 bring? We'll discuss that and so much more throughout the hour. First, let's check in on these public markets and a few key themes. Of course, we're still managing to hold on the gains for the Nasdaq. 8 straight weeks of gains on the Nasdaq and the S&P 500. Haven't seen that for years on the S&P 500 benchmark, at least. So still expectation of 1.5% of cuts in the 2024 year. That's currently what the swaps market is pricing in. Interesting that we're seeing money coming off the table in China. We know we're going to dig into why. This is all about Tencent. This is about gaming. This is once again about the power of the government vis-a-vis the gaming sector in China. So we'll dig into that in a moment from a micro basis. Oil actually holding pretty steady at the moment, but we've seen, of course, a ramp up in oil. Once again, it's going to be on the higher side this week. Last couple of weeks, we've seen that on the back of these tensions throughout the Red Sea. We will be digging into that a little bit more in a moment. Let's move on to the world of crypto, though, quickly, because we are down about 0.9%, but still above the $43,000 level. Ed, what have you got on the micro?
Well, I've got that micro look at the story in China. So China's top video games regulator published a surprise list of draft guidelines, all designed at clamping down on the amount of time that video games players spend on specific titles. This is the market reaction. Tencent, these are the US ADRs, down almost 10%. Another one in Europe, this is Prosus, the Dutch listed shares or Amsterdam listed shares. The market's now closed, but a big majority of this tech investors' holdings are in Tencent, and you can see the market read through that stock down 12%. We have an absolute expert on this topic in China video games later in the show. Then here and now is Elon Musk. Cathie Wood and Elon Musk do a Spaces. It's wide-ranging. Elon Musk goes after the public markets. He basically says there's too much regulatory burden on being a public company, and he wades into the passive versus active investing debate. Tesla is the only publicly traded proxy I've got for you, Caro. It's up 0.6%, up 107% year to date. A beneficiary, one might say, outpacing the S&P 500's gain of 20% in the public markets that Musk had a lot to say about.
He did. And of course, it's kind of music to Cathie Wood's ears, who, of course, has an actively managed set of ETFs. It was wide-ranging, wasn't it, on X? And overall, we did see Elon Musk really pushing back and pushing out, again, it feels, at the state of US financial markets. I mean, we're just looking at the moment of Tesla holders, for example. Just take a listen to what he had to say.
The percentage of the market that is passive is too great at this point. So at the end of the day, somebody actually has to make an active decision. The passive investors are riding on the decisions of the active investors. You get essentially massive movements of the stock based on the decisions of maybe 4 or 5 active major stock pickers.
And look, of course, Elon Musk himself is the biggest holder of Tesla stock, but then it's Vanguard, BlackRock, State Street. We can dig into all of this with Bloomberg's Max Chafkin, and we've heard him rail against the fact that there's a lot of passive money now. Does he have a point?
I mean, there's, first of all, no surprise that he's railing against the, regulatory burden of running a public company. He has for years clashed with the SEC, has, been firing off insults at the SEC, for years. So no surprise there. In terms of the active versus passive, I mean, I think this is a case to some extent of both of these people talking their books. As you said, Cathie Wood, active manager, also runs a venture fund newly, which is making its investments available to investors. She talked about that on the podcast. So there's sort of lots of reasons for them to talk about how, hey, the Vanguard approach isn't great. Also, Elon Musk is a guy who benefits from the kind of vibes style investing. And I think, anything that's not vibes is not as good for Tesla and his companies.
In the 5 or 6 years that I've covered Elon Musk, he has benefited from the capital markets. And he has been pretty clear that he doesn't lose that much sleep over the thoughts of investors. In the even longer period of time that you've covered Elon Musk and Tesla, that has been true as well. Just what was his basic argument about the functioning of markets? This is what I don't get. What is he arguing in favor of?
Well, I mean, he's tapping into kind of a long-running critique about the power of money managers, which you know is not something exclusive to Tesla. I mean, the point is that a lot of investors are investing money with these big asset managers. Therefore, these big asset managers tend to sort of all herd together. And you know, honestly, it's not a particularly novel argument or one that I think holds a ton of water. Obviously, these funds have done very well for most people. And as you say, Ed, you know, Tesla and Elon Musk has done incredibly well thanks to the capital markets, which he did acknowledge, you know, at another part of this X Spaces event. You know, he acknowledged that one of the reasons you put up with this regulatory burden, of course, is because the amount of capital that he has access to on the public markets is way greater than on a private market.
The biggest single shareholder of Tesla, by the way, is Elon Musk, 13%. Then it's Vanguard, BlackRock, and State Street, HDS on the Bloomberg. Bloomberg's Max Chafkin, thank you so much for joining us this Friday. Let's stick with the public markets and get a broader outlook on the technology sector into 2024. Denise Chisholm, Director of Quantitative Market Strategy at Fidelity Investments. Fantastic to have you on the show this Friday. Just real quick, let's get your take on Mr. Musk's view of active versus passive, the influence in the markets. What do you make of that?
Well, I think that when you look back in terms of history, if you were seeing very different market reactions in terms of how stocks were moving, then you would say one is more market moving than the other. I've heard a lot of arguments in terms of, well, most of the market is passive, therefore it's building up these dislocations or potential bubbles causing these massive moves in stocks. And actually, when you look back through history, I'm not seeing any difference in terms of patterns in the data that I look at. So, you know, I think, you know, you can always think about it from an allocation perspective. If you buy a technology ETF or even if you stay in cash as an investor, that is an active decision. So it certainly depends on who you're talking to when you think about active versus passive.
Yeah, and all of this, I mean, they're sort of speaking out of one side of the mouth to be this is democratization ultimately when you're able to have access to big ETFs, but also it's democratization when you're able to have access to actively managed ETFs as well, Denise. And I'm interested, therefore, if investors are thinking, okay, strategize to me at the moment. Should I, with the amount of chunk of change I have in cash, vis-a-vis the amount that I currently have in the market allocated to tech, should I can remain allocated to technology given the outperformance of 2023?
Right. I mean, 2023 has been a great year in terms of technology leadership and an unexpected year in terms of just how strong the market has been. And I think that's a cautionary note to investors by using bad news to stay on the sidelines because stocks are this discounting mechanism. So by the time news gets good, the gains may already be in. But I will say, as we approach 2024, I think that I'm still looking at some constructive signals. One, on the earnings front, both in technology and for the broader market, a lot of things in terms of that we saw costs increase and costs take down corporate profit margins over the course of the last year seems to be unwinding, with unit labor costs decelerating and the PPI relative to the CPI also decelerating. And that's one of the reasons why technology stocks have done so well, even though earnings hasn't been quite very strong. And it's usually when you see stocks move ahead of the earnings, which to most people in the market, that's, well, wait, if the stocks moved ahead of earnings, then maybe that creates a negative risk reward. But when you look back through history, stocks more often than not, which is not to say every time, actually get it right. And mid-cycle earnings tend to be higher if the stocks move first. And I think that that's part of what you're seeing in technology, which is a constructive outlook and a positive risk reward despite the leadership we've seen as we approach 2024.
Denise, I would love to take a look back through history. Let's do it. 24 hours ago on the show, Denny Fish of Janus Henderson joined us. And I made the point, well, if you go back to 2018 when I moved to San Francisco and tracked the NASDAQ 100 relative to the S&P 500, it outperforms. And Denny made the point, well, if you go back to 1995 when I moved to San Francisco relative to the S&P 500, it outperforms. Year to date, the gain on the NASDAQ 100 is 53%, S&P 500 24%. Does anything change that historic trend in 2024?
I mean, what you see, what you're talking about is essentially a statistical concept of thrust, meaning that did this massive momentum, are you more likely to sell that or are you more likely to buy that? And this is true specifically in the numbers that you were just talking about, but even in the broader S&P, 6 weeks increasing on a weekly basis, that's a rare signal. And is that rare signal better or worse? And what you find in history is the more thrust you have or the better something has done, the more likely it is to continue to do well in the future. I mean, the concept of momentum is well explored, but I think that most people want to sell that momentum, where actually statistically, and again, this is not to say that 100% of the time it works, but the more you've seen something move, the more likely the market is right that there is a potential catalyst coming up. And one of those catalysts, I do think, is the increase in earnings that we're likely to see over the course of the next 12 to 18 months.
Okay, so if you've got the capacity to, and you're not just finding exposure via the NASDAQ or the NASDAQ 100, can you rotate within technology? Is it time to broaden out from the Magnificent Seven?
No, that's a great question, because it has been fairly dominant both in technology and in the broader market. There's really been, let's call it one trade, which is technology and technology-related stocks. And I do think 2024, we have the catalyst of potentially lower rates now that does suggest market broadening historically. But on top of that, you have a lot of what I call dislocation variables, meaning that there's a really wide dispersion in the valuations within technology. And typically, when you see wide dispersion, that's not only good for the sector, but it's good for broadening out of the sector. I mean, think about something like software even, that finally for the first time since 2014 is now out of the top quartile on valuation, which changes your risk reward. All of a sudden, you're starting to see these signals broaden out to maybe equal weighted tech, as opposed to something that's been very dominant in the cap weighted indices. And this is not just within technology. I think that this is within the broader S&P. It's been a very tight market in terms of the sector outperformance, but I do think that that's likely to shift, because we're evolving from a situation where 2023 was really a contraction in earnings with higher rates to 2024 potentially being the exact opposite. Rates might have peaked and we're actually starting to see an acceleration in earnings, and that is usually coincident with a broadening market.
Oh, some optimism as we let you do some panic purchasing to finish off this year. Happy holidays to Denise Chisholm. Thank you so much for spending time with us, of course, of Fidelity Investments. Meanwhile, coming up, fresh restrictions in China have sent the video game industry into a tizzy. We'll discuss more with Lisa Cosmas Hansen, President and CEO of Nico Partners, true expertise in this particular realm. Stick with us. This is Bloomberg Technology.
Time for Talking Tech. And first up in the news, Lionsgate Entertainment is merging its studio business with special purpose acquisition company Screaming Eagle. The new entity will trade on the NASDAQ in a deal that values the business at $4.6 billion, including debt. Premium cable channel Starz is not included in the deal. And as of Thursday afternoon, Apple is no longer selling its Series 9 and Ultra 2 watches online in the US. Apple also says it won't be able to repair any out-of-warranty watch models. This comes just days before a ban imposed by US regulators related to a patent dispute scheduled to halt all sales effective December 25th. Sales will continue at Apple stores internationally, both in online and in person. Plus, ASML says it has shipped the first parts of its newest chip-making machine to Intel. Parts of its state-of-the-art high-NA extreme ultraviolet system was shipped to Intel's D1X factory in Oregon, according to Bloomberg sources. It's a win-win for both companies, who are among the first important companies in the chip-making industry. Karen.
Well, let's just stick on really the theme that we were raising at the beginning and the market impact of today of Tencent, which has led an $80 billion sell-off in some of China's biggest online names, Ed. Look, this comes after what seemed as a kind of a surprising position of new gaming curbs, reviving all those fears that Beijing may again be targeting the country's giant internet sector. For more, we want to bring in Lisa Cosmas Hansen, President and CEO of Nico Partners. Look, it is the market research and consulting firm covering the Asia games market and its consumers, and therefore the perfect voice, Lisa, on to tell us just ultimately how much of a shock this was. The market seems to be reflecting a shock. Were you surprised?
I'm based in California, and I woke up this morning a little bit surprised to see all this news coming through. And I saw that the market value of Tencent and some of the major game companies were declining. I think that some of that is a knee-jerk reaction, and I'm a little bit surprised by the severity that the markets have applied to this new regulatory kind of discussion, because it's not even a final set of regulations yet. There's still going to be a month of discussion and input from the industry. And for the most part, the regulations that were quote unquote announced have already been in place for quite some time.
They are draft rules, and the aim is to essentially limit the amount of time that a player can spend on a particular title logged in to a particular online game. It all goes back to the rationale. Why is the top regulator doing this?
Yeah. Well, the National Press and Publications Administration, the NPPA, is the regulator in China that monitors and regulates all of the games world effectively, although there are several other regulators that touch the space for internet cafes and esports and so much more. But the NPPA has put out these measures for the administration and protection of online games, and frankly, I don't know if that's the exact title, but I think that's something similar to that we were reading through this morning. And those measures do not all deal with the amount of time people can spend on games. There's a lot of regulations around the protection of youth, which have already been in place since September 2021, when there was a big push to overhaul how youth gamers under age 18 in China could interact and spend time on games. Some of the measures that were discussed in today's document are sort of a repeat of those. And there are some new ones that might impact adult gamers, primarily around there might be some limits on the total spending on loot boxes and on the trading of in-game items between people or via the platform that they come from. But again, there is no defined limit set yet. And while there are 710 million gamers in China and $47 billion in revenue, and by our estimation, rising to $57 billion over the next few years, some of that revenue might be impacted by these new rulings, but we really don't know what it is yet.
Yeah. So at the moment, maybe a knee-jerk reaction, Lisa. Are the right names being impacted by the knee-jerk reaction? We did see Ubisoft. We did see some other, not just purely Chinese-focused names being wrapped up in all of this.
Well, you know, Ubisoft should actually be on the positive, because today, at the same time that these new regulations, the draft of them was announced, the Chinese government did the world a favor and also announced the approval of 40 imported titles for ISBN licenses. And that is a coveted license. And it brings the total this year to, I believe, 98 imported games approved, which is higher than last year and the year before and the year before that. So it's actually quite positive. And Ubisoft is one of the game companies that had a title approved. And I think that was called Horizon's Phoenix Rising. And so Ubisoft, if anything, should be benefiting from today's announcements rather than get hit by it.
Thanks to Lisa Cosmas-Hanson, President and CEO of Neoco Partners. Just such a deep knowledge of the video games industry globally, but particularly in China. Thank you so much. Happy Friday to you. Now, coming up here on the program, a China chip crackdown. The US is set to thoroughly investigate our reliance on Chinese-made semiconductors. That's the conversation that's coming up next. This is Bloomberg Technology. China tech is under more scrutiny. The US Commerce Department is set to begin gathering information of legacy semiconductors made in China to understand just how reliant the US is on Chinese-made chips. Joining us with the latest, Bloomberg's Mackenzie Hawkins, normally of DC, but in San Francisco. Actually, while you and I were asleep overnight, the Chinese government responded to this issue? What did they have to say?
So what we saw out of Washington over the past couple of days is the Biden administration is weighing tariffs on older model semiconductors produced in China. Now, the Chinese said that would actually hurt the U.S. That would undermine free markets and fair competition. Of course, the U.S. doesn't see China as a market-based actor and a fair player itself, which is the reason that Washington is considering pursuing duties.
So let's talk about that behavior that, once again, Gina Raimondo is really responding to. The worry here is what? They're sort of flooding the market with cheaper goods?
Exactly. So the U.S. has introduced controls on the most advanced cutting-edge semiconductors in China, which are the components that power everything from your phone to your car to weapon systems. But older generation chips, which are still essential to the global economy, Beijing has doubled down on production of those. And the worry is that Chinese chip makers could undercut their competitors with cheaper prices or use that technology as a choke point that could gutter the U.S. economy and really send the entire world into a tailspin if China decides that the U.S. and its allies can't get Chinese goods.
What you have been reporting on consistently is that tariffs and prohibitive action goes hand in hand with subsidy. What the U.S. is trying to do is onshore an entire industry, and they're realizing, it seems, that they're going to have to take action on exports and imports at the same time to be competitive.
Exactly. So it was actually a shortage of legacy chips during the COVID pandemic that spurred Washington to enact the CHIPS Act, which puts $100 billion of subsidies on offer for chip makers, trying to convince them, hey, let's manufacture these critical electronic components here. And the U.S. is doing a similar thing with electric vehicles and other clean energy technologies through the Inflation Reduction Act, which is Biden's signature climate law. Now the U.S. is weighing tariffs on a lot of the goods that they're subsidizing manufacturers to make in the U.S., worried that Chinese companies could undermine that effort.
The tits, the tats that go on. Mackenzie Hawkins, we thank you so much for really covering what is, of course, the ongoing narrative and has been throughout the year of 2023. We thank you for it. Meanwhile, coming up, look, we're going to talk more trade, but this time the commercial disruption in the Red Sea wreaking havoc on the global supply chain ecosystem. We're going to be discussing it all with Flexport CEO Ryan Peterson. From New York, from San Francisco, from an almost end to the holiday period, this is Bloomberg Technology.
Welcome back to Bloomberg Technology. Ed Ludlow here in San Francisco.
I'm Caroline Hyde in New York, and let's get a check-in on these markets. Final day of trade before, of course, for many, a holiday celebration. And we're actually still holding on to some gains in the equity market, up 0.2%. And look, this has been an 8-street winning streak for the Nasdaq and also the S&P 500, not been seen in years. So clearly risk has been on as we think that the Federal Reserve will start to pull back rates come 2024. I'm looking at New York crude, actually just down about 0.1%, but remember, up for a second straight week, really. This is over global tension about to dive into, of course, Houthi rebels impacting some of the trade points throughout the Red Sea, and that has been, of course, driving up the cost of oil. I'm looking at Bitcoin just off about 0.8%, but still holding above that $43,000 level. Perhaps some options just hedging their bets. We're seeing, anticipating that ETF ruling come January. Move on and have a look at what's happening to the Nasdaq Golden Dragon. I shine a light on what's happening on Chinese stocks because, once again, it seems as though the market was taken off guard by some moves against the gaming industry, particularly about adult gamers' ability to make purchases within certain games. We're looking at Tencent really taking a hit there, off by more than 9%. Apple off by only 0.3%. But look, we're still looking as though that overall ban and import ban coming to affect their watches is going to be coming into play come the 25th of December, Ed.
Global supply chains are a top and critical story. Attacks by Yemen's Houthi rebels on commercial traffic in the Red Sea are causing havoc in one of the world's most critical waterways, disrupting shipping and endangering the global economy. For more on the picture of that global supply chain, we're joined by Ryan Peterson, the CEO of Flexport, a leader in global supply chain technology and data, frankly, as well. Let's bring up a map of global shipping lanes and explain what's happening. The Suez Canal is a principal route. It's a shortcut. Attacks are impacting the ability of carriers to go through that shortcut. What is the net result that you're seeing?
Yeah, and you're seeing an effect, especially in the container shipping lines, where there's effectively no container shipping lines transiting through the Red Sea right now. So you see a lot of dots that are going through there, but these are other kinds of shipping lines. But the ocean containers, this is what carries most of the goods that you buy, finished goods traveling in containers, have decided it's just not safe for crew member safety. One of them got hit with a missile, 2 got narrowly missed, and these companies said it's not worth it, both the insurance premiums, but also just crew member safety. And so they're going around. The impact is, the easiest way to think about it is, well, it's a 25% longer journey.
Right.
And now, of course, that's delayed, but it's less about the delays than it is that's a reduction in supply of ships, because you now need more ships to service the trade lane. Is it 25% more ships?
In our Bloomberg reporting, Flexport has shared data on some of those diversions, right? Around 180 vessels finding an alternative route. Just explain why Flexport tracks that data.
Oh, well, we're one of the largest freight forwarders in the world, and so we're technology
platform
based.
Essentially.
Yeah, it's a platform for shipping cargo around the world, and so one of the things that makes people choose Flexport is we do a good job of monitoring where the cargo is, and we use satellites for that. We also use integrations with the carriers. One interesting point about technology here is, like, a lot of the ships that are transiting the Red Sea or that are near that area have turned off their satellite transponder. So, because they don't want to be targeted by the rebels, can use the same data. So at the exact moment you'd like to see where's the ship, what's going on, it disappears from your system. So, but a 25% reduction in supply can lead to a huge swing in price. We're seeing prices between 3 to 4 times higher for shipping from Asia to Europe on ocean freight. And that's a big impact on the price of consumer goods. We talk about inflation. Maybe people think it's under control, but all of a sudden you have these new factors that weren't accounted for.
And we've seen the price of oil tick up a bit, Ryan. What about the impact on your own business? Because many would say during the supply chain headaches, if that puts it lightly, of what occurred during 2020, 2021, well, that was a boom time for Flexport. How does it ultimately impact you?
Well, at the end of the day, we're trying to serve our customers and do a good job. So when prices go way up, they have to pay more. And, of course, that is what it is. It's price. It's out of your control. But it creates a lot of chaos. And because imagine that ship that got hit with a missile, for example, the MSC ship, the Palladium 3, it got hit just off the coast of Yemen with a missile. Well, it was meant to go to Barcelona and pick up 4 containers for a Flexport customer and bring them to Morocco next week. That's happening en masse on every ship that got diverted, have to replan every schedule. So teams are kind of working overtime right now trying to keep up with this and do a good job for our customers. That's what they pay us to do, is make sure their cargo arrives on time, or if not, that they're well informed about what's going on.
And a lot of that customer relationship is something that you were really focused on when you came back to the helm of Flexport, something you thought had perhaps been sacrificed during your transition. Ultimately, how are your employees engaged at this moment? How are they feeling? They've had, well, a relatively turbulent time, to put it lightly, of 2023.
Yeah, well, it's been a tough time for the last decade in global shipping. There's always ups and downs and chaos. We get pretty energized when there's something like this where you see, hey, the entire reason that we're here is to help people move cargo around the world and identify where it is, when it's going to arrive, get them accurate data. So we had a team of engineers worked all weekend to completely update our product so that we turn every container ship orange on our map now. So if it's going around, if it's diverted or delayed because of the Suez crisis, it turns orange. That was, kind of Herculean effort by our technology teams working all weekend. And that's what energizes us and makes us really proud to be in this business.
So Ryan, you're back at Flexport as CEO. When last you were on the show, you joined us as a new member of Founders Fund's team. Dave Clark then left Flexport and you went back to being CEO of Flexport. Explain how you manage your time between the two and what you're doing mostly.
Yeah, so I'm still on the team at Founders Fund as well as a venture partner there. Been mostly focused on Flexport. Flexport's a major holding for Founders Fund, and I think they understand where I'm at right now. Is like got to get Flexport going in the right direction. We're well ahead of our goals, so we feel good about that. Founders Fund is a place where we're very patient, looking for the perfect deals. We're not out here the most active investor in the world. We want to be contrarian. We want to find things that other people aren't finding. So it's a moment for Founders Fund in general to say, hey, let's take assessment. We've been not really aggressive, writing tons of checks. We're looking for the fat pitch of like the perfect company that comes along, and we do get to see most of the companies out there that are, everybody wants to get Founders Fund. As an entrepreneur, I can say that of having tried to get the best investor has always been Founders Fund.
I know Dave took to social media when that change happened, but just as a point of clarification, when you did join Founders Fund, at that time, were you expecting that you'd have to go back to Flexport, or that's something you reacted to?
No, I think it wasn't. It was sort of a board decision that happened a couple months after I'd been at Founders Fund, and realized, hey, the Flexport needs to get more customer-centric, needs to really focus on, to grow in freight forwarding, it's a B2B business to business. It means you have to spend a lot of time with your customers, and I think that was something that we weren't seeing enough of, and that's why I came back to Flexport to go really reignite that culture of Flexport, of customer obsession.
And you sort of said that actually you're outperforming where you thought you'd be, Ryan. I'm interested in, well, as we're about to all perhaps break up for the holidays, you've also got an insight into that because Flexport bought Shopify's logistics part of the business. And then how much have you been able to focus on that, this new area of growth, or how much has it ultimately been a bit of a distraction to what now is the focus of B2B logistics?
Oh, well, that's also B2B. It's serving businesses is our customers for that. It has a really great leadership team, and we sort of run it as a business unit that's, I wouldn't call it autonomous, but it runs on its own with an amazing woman heading that named Parisa. And she runs that, but I work with her almost every day on strategies and how do we cross-sell that into our core customer base for the freight forwarding business and vice versa. So, no, it's not a distraction at all. It's really part of the end-to-end strategy of taking goods all the way from a customer's factory now into consumer stores and to retail stores and do that on an end-to-end basis. And with things like the Suez, you see how powerful that is because, if you're just sitting there running a fulfillment center, there's no inventory, you don't know when it's going to arrive, you're not connected all the way back and able to reroute things and plan things and make sure the cargo gets where it needs to be.
And boy, is everyone looking at when their deliveries are coming when it comes to the holidays at the current moment. To that end, is the consumer strong from your perspective?
Seems to be. In the U.S., we see demand is back above 2019 levels. Of course, volumes went way up for shipping volumes during the pandemic when people weren't able to go and buy goods and services. But what's very interesting is that while service consumption has gone way up, things like travel and whatever it might be, restaurants and massages, those things have gone back up. But goods consumption hasn't come down. It's still above 2019 levels, pretty healthy consumption. And a lot of people predicted, goods is going to come down as these services go up. But actually, services have gone up and goods have stayed strong. So, yeah, the consumer seems to be pretty healthy in the United States.
Nice macro perspective to end it on, Ryan. Thank you so much for your time. Ryan Peterson is, of course, Flexport CEO. Busy time across the board. Meanwhile, coming up, look, we're just talking about geopolitical issues and real attacks in the Red Sea. We're now going to talk about cyber attacks, too, poised to increase, unfortunately, in 2024 after wreaking havoc this year. We're going to get an inside look with Bipul Sinha. He's, of course, Rubrik. This is Bloomberg Technology. Recent reporting from the Washington Post has detailed how the Chinese military in particular is ramping up its ability to disrupt key American infrastructure, including power, water utilities, as well as communications and transportation systems. And this year alone, cyber attacks have wreaked havoc across several industries, not to mention healthcare, for example. Rubrik CEO Bipul Sinha is here with us to really talk about, the data that you focus on. Of course, you're focusing on data management, recovery from ransomware attacks. You're also thinking about how it can accelerate cloud mobility. It feels as though it's a bit of a murky outlook for 2024 when it comes to cybersecurity.
What has happened is that everybody is realizing that cyber attacks are inevitable. And every organization in the world has already been penetrated, and the latest news around China and the US proves that point. So everybody has to think about how do they plan to prepare to recover and be resilient against cyber attacks, be it is nation-state actors or somebody's board in their basement attacking large corporations. And that's the landscape we are looking at for the next year.
Let's spare a thought this holiday season, Caroline, for the CISO or the CIO. And I'm not talking about Chief Investment Officer. Here on Bloomberg Technology, we're talking about Chief Information Officer, right? If something goes wrong, they're the first people you blame in the context of a cyber attack. Beeple, is the CISO, Chief Information Security Officer or CIO, going to be the hero of the C-suite in 2024?
I personally believe that the CIOs and CISOs job is merging because there is no IT without security. And if you look at the evolution of the job of the CIO is to put together a set of services for the business to reduce the risk. And CISOs plays a major role. But the challenge is that the cyber has emerged to be a big risk. And the couple of latest cases where CISOs have been personally responsible for cyber attacks. So in some ways, they are the heroes as well as they are the victim. So I feel that the discussion has to be reframed where instead of just focusing on preventing attack and stopping attack, CISOs has to be thinking about how do I recover because attacks are inevitable. And that's the landscape.
Understandably, many CISOs and CIOs watch this program. And so if you're out there and you are working at a technology company, give a bit of support this holiday season to your CISO or CIO. Where the attacks are targeting, you talk about sort of edge devices. What we mean is routers, points of vulnerability in IT infrastructure. Why do they focus attacks there?
Attackers are going after the easiest way to enter. In many cases, attackers are not hacking in. They are logging in. They are actually playing with our emotions to get our credentials and then log in and to do the damage. Stopping attack is impossible because there are just so many ways to get in because the volume of data, velocity, variability of the data has gone beyond human comprehension. So the question is, what is the strategy to be able to recover and be resilient against attack? And everybody has to focus on that. That's how the CISOs will succeed, and that's how we'll succeed in the new year.
You're also potentially going to be IPOing in the new year. How's that going?
I mean, we are focused again on building a long-term business. I'll leave the IPO to the experts. I can't comment on it.
All right, Rubrik CEO Beeple Singh, come back again, and we will ask you again when you're going to take your company public. We appreciate your time and the outlook for 2024. Thank you. Now, coming up on Bloomberg Technology, Hunger Games owner Lionsgate taking its studio business public via a SPAC in a $4.6 billion deal. We're going to have those details next. This is Bloomberg Technology.
Let's turn to the world of entertainment. We're all talking about it online. Lionsgate, the studio behind the Hunger Games, John Wick, Twilight Saga, is taking its studio business public. Now, that's via a SPAC in a deal that values the business at $4.6 billion, but that does include debt. Joining us now to discuss, Bloomberg's Felix Gillette. And Felix, why this seems to be a theme of ultimately big media companies splitting themselves in two.
Yeah, well, they've been talking about this for years, about separating the movie and TV assets from, essentially from Starz, the cable and streaming distributor. And yeah, it creates a pure play content company. You know, there's going to be a lot of M&A activity in the media space next year. We've just been talking about Warner Brothers Discovery kicking the tires on Paramount. Now you have another option for a big content library. If you're looking to bulk up your streaming service, you look at Lionsgate, probably 18, 19, 20,000 movies, TV shows in their library that you could add in. And now you don't have to deal with Starz, which is another problematic declining cable asset.
I mean, you say you don't have to deal with Starz. I guess that's my question is, what are the underlying factors that move to the separation? And indeed, the underlying factors behind the idea of a Warner Brothers Paramount, is it just that kind of broadcast linear TV is dead?
Yeah, I mean, I think it's just the continued decline of people cutting the cord for cable. Also, TV advertising, is also going downward. So what do people want? Well, the studio Lionsgate, you look at their box office this year, they did great. They had 2 really big hits. Saw was also pretty popular. I think they'll end up as probably the 6th biggest U.S. domestic distributor this year at theatrical, over $500 million in ticket sales. So that part of the business is very appealing. But what's going to happen with the Starz side of it? They're already losing. Everyone's cutting their cord. You're losing subscribers. That's just going to be a continued trend into the future.
Felix, Gillette, we thank you. It's going to be a busy ride for 2024 when it comes to media M&A. Meanwhile, earlier this year, Apple engineering alums launched an AI pin that's campaigning to replace phones. Just the other day, I had a chance to try it out with the co-founders of the company. Have a watch of Humane. Wearables on a few wish lists this year, and maybe your name is already down on the wait list for the AI pin made by Humane. No ordinary sleep or fitness tracker. This AI wearable wants to replace your phone. They want you to talk instead of type. They want you to remain present instead of swipe. And there's been so much hype around these former AI employees, Bethany Bongiorno and Imran Chowdhury, and what they've made, that we wanted to get, a reality check on actually using it. Translate into Japanese. Where is the best sushi local to here?
地元で一番美味しい寿司はどこですか?
Capture this. The husband and wife team hope that the AI pin will be in consumers' hands early 2024. And look, if it's as easy as it seems, I'll be interested in having it, but alongside my phone. Because for now, I think it's pretty hard to prise yourself away from the screen fully. Look, the apps of music and search are great, but what about payments? What about other apps that we interact with? For now, I think you're going to have both. And Ed, when we think about the hype behind these former Apple employees, the hype was backing from Sam Altman himself. The hype was hundreds of millions going towards them before the actual concept became a proof point. Now they've actually got to get these things into consumers' hands. The theory is by early next year.
I think it's interesting, right? Which do you go to, the touch and voice or the hand hologram? Both? It's hard to see. Let's stick with AI. A growing list of competitors emerged this year to take on ChatGPT. What can we expect for next year, 2024? Joining us now is Bloomberg's Shireen Ghaffari. There is a long list. You wrote about them in your newsletter. Where do you want to start? There are many competitors out there.
Yeah, I'll say just, to lay the groundwork here, the real game changer was when these open source AI models started to come onto the scene. And so first we had Meta release Llama and then Llama 2. And now we have a new buzzy French startup, Mistral, that's launched its own open source model. And what those do is allow really anyone for free to download a very similar technology to what OpenAI has. Albeit it's some people say 6 months or a year behind the closed source models, the proprietary ones. But that's really enabled this whole wave of new startups that are not just building on top of OpenAI's API, but they're actually, manufacturing these LLMs, building off of what's just open and out there for free.
When I think of Mistral, I think of perhaps some of the lobbying they were having to do of the EU AI Act and ensuring that this sort of regulation that starts to come in, globally speaking, doesn't choke off the innovation from the smaller players. Is that a key concern for 2024?
Yeah, absolutely. There's a real divide in the AI industry right now about whether there should be regulation on open source models. Of course, the regulatory concern there is that if anyone and everyone can develop an AI model, could then it be used for something that's harmful? Could someone go and use that to create a novel virus and unleash it on the world? Could it, someone make it and start having the code delete itself or replicate itself? Now, I'd say these are all very hypothetical scenarios, and I think the open source community would say that that's all way too hypothetical of a risk for us to actually worry about right now.
Shireen Ghaffari, it's a great story to end the year on. We thank you very much indeed. That does it for this edition of Bloomberg Technology for
what a year.
2023.
What a year 2023. 2024 is going to be even bigger. Recap on the podcast. A big thanks to all that listen. From SF and New York City for 2023, this is Bloomberg.